Okay, hi everyone, and thanks for joining us for this session. First of all, I think it's probably a really good idea that we clarify what we're talking about when we talk about VC 3.0. It's just a shorthand way of recognizing that up to this point, there's been two very distinct areas in VC, and they've really been, first of all, there was the creation of the sort of VC paradigm, if you will, back in 1960, with the investment by ARDC and the Digital Equipment Corporation. That created a 1,000x return, 100% IRR, and everyone at that point went, wow, what is this tech investment business? This is amazing. And so then in the 70s, of course, you had Sequoia and Kleiner and a whole bunch of other guys start up the 70s and 80s, and all the sort of name brand VCs in the Valley. But then the rest of us started paying attention around the world. And so the Silicon Valley model morphed, which is what we refer to as VC 2.0, and morphed just in the sense that you could go to pretty much any population center in the world and find a replicate of the Silicon Valley ecosystem. And of course, and then as the family offices started, and the entrepreneurs started coming into these centers, they grew to be very, very significant centers. And now you have the situation where China now is battling with the US for first place in terms of the size of the actual VC ecosystem. And then of course within China you have dozens of emerging centers of entrepreneurship. So what do we talk about with VC 3.0 is a shift in that sort of very, very, we're basically moving on from the paradigm where we can assume that every decent sized population center has an ecosystem. What we were fascinated by in our first fund was VC remains a very manual, process driven, very siloed environment. And for all the talk about a global VC community, we didn't find that such a community really existed. We found that there were VCs that would be polite to each other when they go to conferences and we'd all hang out and be friends. But basically, we're very protective of deal flow. We used a lot of manual processes. And for the most part, the funds were not able to really scale beyond a certain number, except in exceptional circumstances with companies that have been around for 50 years, like Sequoia. So running a first fund, which is what I did, my first fund was basically a little micro fund, it was a $20 million fund. What we discovered when we ran this first fund is it was really hard work to basically build just even a small portfolio of 20 investments. There was just a lot of manual process involved, and the legal work would always take months in every deal. Our deal flow wasn't the greatest. And so we really struggled in this fund. Now we've done well. We've ended up with a 22% IRR. We've doubled the money in 7 years. Great. But the whole time I was running this, I really felt like I was running something more akin to a casino than a venture capital fund. And so for our second fund, we decided that we wanted to raise more capital. But the first thing that we wanted to do was really understand the data and understand the odds. Because if we were going to basically beat the odds, we had to first understand what they were. And so that's what we decided to do. And for this process, I enlisted the help of one of the most commercially successful data scientists in the US, my partner, Dan Huchter. Dan was the founder of SageMaker in the early 90s. Went on to do AI and data analysis at Sprint, and then was headhunted by Bankrate and took their revenues from around, I think, 30 million a year to about 570. IPO'd the company, is now a limited partner in a number of funds, but full-time GP with me at Hatcher Plus. And what Dan and I decided to do, we both have programming backgrounds, we decided that we wanted to do data analysis on as many companies as we could get our hands on. And that began with an analysis of around 15,000 deals. And over 3 years, it's grown to an analysis of pretty much every deal that we can find between 1998 and now. It's about 600,000 transactions in all. It's 22 years of venture investment. And from that, we've built 4 billion virtual portfolios. We did this because we wanted to understand what goes on inside venture capital if you look at it from a holistic standpoint. If you stand above the venture capital industry and you try to figure out what's going on, what happens? And we discovered some really simple facts that I'm going to share with you right now. One of the really simple facts was venture returns don't follow a normal distribution curve. It's not like a public equities portfolio. It's not like a real estate portfolio. Basically, one event in a venture capital fund can return the entire fund. And my favorite, and we call that a power curve effect. And my favorite example of that right now is you have Coinbase going for $100 billion listing. You have Union Square Ventures in New York that owns 8.2% of it, $8 billion. Their entire fund that they invested into this company out of was 200 million. So here you have a power curve effect that consists of a 40x return on the entire fund. So that defines a power curve effect. If you have one company in your portfolio that goes on to become a unicorn, you've got a power curve effect in your fund, and you're almost certainly going to get not just a return of the money that was invested in the fund, but a multiple on it by virtue of having that power curve within it. Another quick thing about unicorns is unicorns almost never stop at $1 billion. If you think of any unicorn that you can, there's 610 or 630 unicorns in the world right now. Most of these unicorns are not sitting at $1 billion level. They're at 4 billion, 8 billion, 16 billion, 60 billion, 100 billion. These are massive, massive wins. And so when one of these things hits, the power curve effect of that is significant. And in the case of Coinbase, you don't really need to worry so much about what else is in your fund because you've really returned the entire fund from one investment. So we asked the question, how often these power curve effects occur? Because we found that to be quite a fundamental part of the equation. And we discovered it's roughly 1 in 100. That's a useful kind of fraction that you can think of. So 1 in 100 seed stage companies will go on to become a unicorn. The last question that we wanted to ask was, what is the quality threshold for becoming a venture invested company? And this took us on a journey around the world. We ended up talking with about 160 different VC funds. And we discovered that basically professional investors invest at a rate of 1 every 100 business plans. So 100 business plans come in the door, you invest in one of those, and then 1 out of every 100 of those will go on to become a unicorn. So that's the math. It's a 1 in 10,000 odds that that business plan that you're looking at right now will become a unicorn. So how does that translate into a portfolio strategy? What we found is, and this has since been backed up by some great folks at INSEAD, Google Ventures, Institutional Investor published an article on this last year that if you contact me, I'd be very happy to send to you. What we found is basically if you put together a 100 company portfolio or 100 investment portfolio, you're going to get a return on average of around 2x in 10 years. If you take that out to a 2,000 investment portfolio, your return doubles to around 4x. And you can see in this chart here that we've planted in the middle of the chart. It's just a very simple equation. And as you go below 100 investments in your portfolio, your range of returns narrows. And we found this to be such a significant factor that we've built our entire fund strategy around this. So we're looking to build a 1,350 company portfolio just quite simply because we want to create a predictable return from a portfolio that's going to be able to output something that we can track on a bell curve. Below 100 companies gets very difficult to predict what's going to happen. Above 500 companies, you get a pretty good understanding of what's going on. At 2,000 companies, you're looking at an absolute worst case scenario of around 2x, a mid case scenario of 4x, and to 20% likelihood of 8x or better. We really like that curve, and we think that's a really brilliant curve to bring to investors looking to invest in venture capital. We also did some study on, as part of VC 3.0, we think it's really important to get a handle around where the returns are coming from so that when you're constructing a portfolio, you can say hand on heart to your investors where the returns are going to come from and why. And what's fascinating about the returns that we've put up here is if you look very closely at what this chart is saying, you've got formation, then you've got pre-seed, seed, Series A, Series B, Series D, Series E, Series F. I'm not sure if Series F makes it on the chart actually, but what you can see here is the returns really cluster around the earliest stages of life. And the first thing anyone always asks when they see this chart is, does this include write-offs and failures? And absolutely it does. So when you're investing super early, providing you make enough investments to withstand the high failure rate, you will get much, much better returns. There's some folks that invested in DoorDash and Airbnb recently that made just phenomenal returns, 600x, 1000x, 400x on those investments because they came in at the very, very earliest rounds alongside or just after the accelerators. So that's our strategy as well. We really like doing that for two reasons. We like We like it because we're going to end up with a higher exit multiple, but we especially like it because we've gained a pro rata right that will allow us to stay at the table for these investments for as long as we want to stay at the table. That's something that's really important, we think, going forward in venture capital. We've built a global deal network because we think that VC needs to become less siloed. What we want to do is we want to see all the deals that are out there. So we have agreements and arrangements with the folks here on the left, whereby we can look at their deals and co-invest with those deals. And on the right, you can see there's many more blue dots than there are logos on the left. There's a whole bunch of angel networks and family offices and other people that are sharing deals with us. Why? Because we can do a lot of useful things using our AI tools on the back end to return some analysis and some understanding and some additional data when they get a deal coming in the door. So this allows us to see roughly 30,000 new deals a year, this network, which is awesome. We think that's about approximately 25% of the startups that start up annually around the world. In the next 3 years, we want to get to around half the number of startups that there are in the world on our platform, because we think that that's just really awesome if we can get to that level. Almost everyone that's on our platform uses our technology in some way, shape, or form. It's called the VAS platform. It stands for Venture as a Service Technology Platform. We've basically built this as a way of maintaining your own portfolios, whether they're virtual portfolios or real portfolios, so that you can keep up to date on things that you might like to invest in. But what we're really trying to do here is, again, in the VC 3.0 world, everything will be connected. So when you come in through our platform, you can actually connect to anyone that's sharing deals with us, and you can find deals using AI scouting tools. It's really awesome to use this tool because you can basically go in there and type in vaping or health tech or something, and it will return a response for you of the companies that are operating in that area, and an intelligent response that's ranked by relevance score and also by our impact assessment. And on that story, one of the things that we're seeing is a very strong trend in venture, particularly with family offices, is everyone is tired of what's happening to the planet. People want to invest in things that are doing good things for the next generation, and particularly the next generation of investors want nothing to do with technologies that are basically causing negative outcomes. So we find that there's a lot of emphasis now, particularly since COVID, on impact scoring. What we've created is an AI-based impact score that can score at the very earliest stages of a company and understand what that company can do from an impact standpoint. Lastly, reporting and automation are two things that bedevil the industry as a whole. There's just not enough transparency. There's not enough reporting on demand. There's not enough access to data. Our platform is completely open, transparent, and you can push a button and generate an LP report in 5 seconds. That, by the way, used to take me 4 weeks to do for LPs. Now it takes me 5 seconds to create the report and send it out. So what we're talking about with VC 3.0 is really just a situation where we are creating the kind of efficiencies that allow us to see a large amount of deal flow, but also creating a scenario whereby we can provide useful commentary on the deal flow, and then once a portfolio has been created, create very useful reporting tools that enable you to stay up to date, co-invest, and do all of those other cool things, which is the reason you became involved with the fund in the first place. Love to share any of the information that you've seen here today in greater detail. We have a white paper that we've written around our research, which we're happy to share with anyone that's interested in our general research that we've done on the venture industry. The last thing I'd leave with, we talked a little bit on the previous panel about Singapore as a center. We really like Singapore as a center for fund management. Our fund managers, first degree global asset management, are awesome guys. And we have great partners also in Ascent Fund Services and PwC. We also have a partnership with CapBridge and One Exchange, which is the leading private exchange in Singapore. So what we've tried to create within the Singapore ecosystem, but for a global audience, is a very simple way that you can jump in, create a fund, invest in companies, but have the whole thing be managed professionally by people that are MAS licensed in each of these places. So that's just a hint of where we see the VC process going. We think it's going to be data driven. Gardner completely agrees with us, and they think by 2025, 75% of venture firms are going to be at least basing part of their decision-making on using AI and data analysis. We like to think that we're in a pretty good spot right now. We license that technology for free to anyone that wants to use it. So if you're interested in using AI to help with your business, just let us know. We'd be really happy to talk with you and see if we can be of assistance to you. That's my presentation. Love to hear any questions that you might have on what we're doing, and any thoughts that you may have and stuff that maybe we've missed on the journey towards a VC 3.0 paradigm. Thank you.